Welcome to Fund in Focus. I'm Brett Winton, ARK Invest's Chief Futurist, and with me I have Tom Staudt.
Thanks, Brett. Today we're going to talk about a fun one, the ARK Venture Fund. Now, this one is particularly interesting, and I think especially for advisors as well, because it's really breaking down a new asset class, one that advisors have not always had access to across their entire book. So maybe let's start. The name is ARK Venture Fund, but it has more than just early stage venture capital. Maybe talk about just the stages of the portfolio, about what's in this, and then we'll go into how advisors can access it and how they should think about positioning.
Sure. So the ARK Venture Fund, as with all of our funds, focuses on technology. This is primarily, and in fact 80% or around 80%, private companies, so they're not publicly listed. SpaceX is an example, or Anthropic, the AI company, OpenAI. So these are companies that are not publicly available to invest in, that are in this portfolio, and then the remaining 20% is exposed to publicly listed innovation securities, the likes of which are in our flagship innovation portfolio.
There was a study that came out not that long ago that for the average retail investor in the U.S., that some of the most searched for names in online trading platforms were actually SpaceX, Epic Games, XAI. I can't remember the last one, but it turns out all of those names are actually in the ARK Venture Fund. But there are also a bunch of names that probably most people have never heard of. How do you think about the balance of delivering to advisors the ability to go to their clients and say, you've always asked about that name, you couldn't get that, I've got you in that name, versus the hidden gems, the names that people aren't familiar with but are going to drive huge value? How do you think about that when you start thinking about the investment side and the portfolio and the valuations of those kind of two categories?
Sure. Well, so first of all, those names that all the advisors or all the end clients are searching for and trying to invest in, also venture investors are trying to invest in.
That's right.
So getting an exposure to OpenAI is not something that anybody off the street can just walk into.
That's right.
Or to SpaceX, or to XAI, all of which are in the portfolio. And the reason we're able to get access to those companies, even though we don't have a long we're not Andreessen Horowitz, we're not a venture first shop, is because of the research we do on innovation and the decade we've done. We've published that research. And so every company we talk to, management team that we talk to, already knows who we are and is happy to have us on board. And that's not true for a lot of investors. And so it really gives us a competitive advantage in terms of being able to expose clients to names that we think are really well positioned and at provocative valuation points. Every name that we assess, as with our publicly traded portfolios, we do 5 and 10-year price targeting exercises. We have a return on capital requirement of a minimum of a 15% hurdle, meaning a rough doubling over 5 years. Within venture, we expect more like 25%. So we need a higher return rate expectation in order to take private exposure. And that's because within the context of this portfolio, we could always go into the public market if we think there's a better exposure for clients than the one we're about to take on the venture side. And there are many companies that people haven't heard of yet that we think are going to be the next SpaceX or the next OpenAI or the next XAI. Replit is an example of a really provocative company in the portfolio. One of the obvious byproducts of the acceleration in artificial intelligence is it makes coding very easy. Well, Replit is the platform that allows everybody to easily write and ship code using AI tools. So there's something like, a little less than 30 million professional coders in the world. Well, Replit has just a little less than 30 million users on its platform. It's not because all of those professional coders are on the platform, but it's because, we have every one of our analysts has coded on Replit to some degree. And it's because it makes it very easy to take away the burden of kind of all the back end setting up you need to do in order to code, and just allows you to deploy code and have it operate. And so it's an example, and there are a number. Figure AI is another in the humanoid robot space of companies that, the average person might not have heard of, but we have approached because we have come across them in our innovation research, and they're happy to have us on board, and we think we're getting client exposure at a really great entry price.
Now, to be clear, the fund does not have a qualified or accredited investor requirement, and the minimum investment size per client is only $500. So an advisor that's watching this has the ability to put really their entire book of assets in the fund in some way, shape, or form, but from a rules base, but also from just a sizing the investment standpoint. So with that in mind, we're a long way away from the old 60-40 portfolio of equities to fixed income. Where is the right sweet spot for venture capital private equity when it's being introduced into a client's portfolio for the first time?
That's a good question. And I think it depends advisor by advisor. I think generally people should have an aggressive innovation exposure given where we are in the interest rate cycle, given what's happening with technology, and given, frankly, how inexpensive these assets are. On the venture side, we have, an amazing ability to pick and choose deals, in part because we started it, we didn't start at the height of the market. Yeah. So there's lots of companies that have come to us that are clearly in a lot of trouble, that are trying to skate by like very high valuations that they have signed in 20 and 21. And we can avoid those traps. And I think that, a 5 to 10% exposure to venture is something that an institution might do. A 5 to 10% exposure to innovation generally is something that an investor might do, and then you could apportion a part of that to venture. The way I think about this portfolio and what excites me so much about it is that to date, to get very good venture exposure, you basically had to be rich.
Yeah.
And that's not fair.
No,
right?
It's a tax on the lack of wealth.
Yeah. And I think this is the most efficient venture portfolio in the world. The reason traditional venture investors don't want to package their product in their funds in this kind of product is because they would not be allowed to charge carry. Meaning when you charge carry, if I invest in an asset at $10 and it goes to $100, they would charge a 20% carry. So they would take $18 of the dollars out of the pot at the end.
Yep.
That's very expensive, right? So instead, this has just a traditional management fee. But you get all of the first-class venture exposure that an Andreessen Horowitz would be able to get because of our brand and our ability to kind of know and help these companies understand innovation. And so I think for no matter how wealthy you are, this is the best venture exposure you can get. That's my belief. And we think it's an important philosophical principle that should be available to everyone. Yeah. And from an advisor perspective, if you have a book of business, you no longer have to treat the guy that has 5 million net worth differently from the person that has 500,000 net worth. They can all get the same proportional exposure to this fund.
What about liquidity, right? So one of the questions is always, well, that's great, but that wealthy person has, more assets and liquid, and they can move around things from a liquidity standpoint. The lower end, as you just said, has more need to access the cash. This fund actually has liquidity.
Right. So the fund can redeem up to 5% per quarter. And so that allows us to use the public equity book to facilitate outflows if need be. And we do operations management to make sure that we accommodate that. And in contrast to a traditional venture exposure, you have to say, I'm going to commit capital. And then they come back to you and they're like, okay, we need that capital now. So you basically have to carry it in cash as dead weight in your portfolio until suddenly it gets committed into, the riskiest, least liquid part. And so it's actually, pretty difficult to manage into. Whereas this, as with a mutual fund, or people are probably familiar with the private credit funds that are in interval funds, right? Then you can, allocate to it as you would any fund. And, unless everybody is trying to withdraw at the same time, you could get your entire allocation out. So if more than 5% tries to redeem, then it's pro rata allocated. So it's actually a less of a management burden to the individual investors who are in the fund.
You raised a couple good points there. It is an interval fund, so that is a regulated, SEC-regulated 40 Act fund with a board of trustees. It's audited by Ernst & Young. It's priced every day at NAV and fair value. It doesn't have those qualifications or accreditations. But the question that we most get as a result of that is that, that people see the portfolio, and unlike an ETF, which has effectively a pro rata basket delivered for new money coming in, how do you think about maintaining positions, adding positions? Are people going to get the portfolio that they see, the names that you referenced that are, those great names, or those names that people are asking their advisors about, but advisors can't help them with? How does the fund, how by extension does the team at ARK make sure that portfolio is going to continue to look like that or similar to that?
Well, right now it's actually the excuse we have to make to companies, and the real benefit that companies have offered to us is they are letting us invest even though our check size is small. Like, we could deploy a lot more capital efficiently than we are right now. SpaceX literally had to rewrite their rules to let us onto the cap table because we're still a small fund. So the fund can also operate in the secondary market, which is not common amongst venture portfolios. And so, oftentimes, particularly these companies that are staying private for longer, even if they're not raising capital, they need to provide liquidity to their employees who have a large share of their net worth, exposed to these businesses, and might want to buy a house or might want to take compensation for another purpose. And so we can facilitate that liquidity on behalf of their employees. The real critical milestone for venture investing is getting onto the cap table so that you've been qualified in by the management team, they know who you are, and they'll expose you to tender offers, for example, for employees. And so one of the things we've had to be very careful about, and the teams work very hard to do, is to get these exposures direct on cap table, which is in contrast to some of the other products out there that are signing things that are they're signing deals that frankly aren't as solid in terms of their actual exposure to the companies that they say they're exposed to. So not only does that put them at risk of actually realizing the potential appreciation of the investment, but it also means that they can't necessarily, repeat the exposure.
Yeah.
And so kind of our even in our signing of deals, making sure that we have pro rata rights on deals, making sure that we are, signed in and have really good relationships with management. And so they'll deal us in for a bigger check when we have one to write. That's an important principle that we've approached this portfolio with.
One of the advantages I think that makes it very interesting is that if I'm an advisor and I have somebody looking at putting this into, say, an IRA, long time horizon, the fund is also evergreen in terms of the fact that it doesn't have some expected lifespan, 8 to 10 years, the way a traditional venture fund would, and it's going to return the capital. And in many cases, those companies miss quite a bit of value creation on that name actually going public and returning the capital. Whereas you have the ability to continue to hold that. You mentioned the public part of the book, which provides for liquidity, but it also allows for an arbitrage where you think there's great value still instead of being a forced seller. How do you think about that just overall in terms of portfolio construction from, a diversification standpoint, a time horizon standpoint, a turnover standpoint?
Yeah, actually, another contrast between the way we manage the portfolio and other venture fund managers is that other venture fund managers actually have a lot of, call it skewed incentives around fund timing. They're going to raise the next fund.
Yep.
They want to crystallize the carry on the gains to pay out themselves. And so they will do things that, are certainly they need to do them from an operational standpoint in order to facilitate kind of their raising of additional funds and distributing out to shareholders, but is not necessarily in the best interest of the companies that they're invested in or in the end clients. And so I do think about this as a fund that, should perpetuate and should help a lot of businesses get into the public markets over time. And it also, reduces your risk of suddenly it's like capital is coming back to you in exposures that you don't want it to come back to you in. And if you think about even from a in a taxable portfolio, that could also be beneficial in that you're not getting distributed out
Yes, that's
taxable
right.
gains.
That's exactly right.
You know,
and getting into a new fund.
Yeah, and
That's
then
right.
you have to go into a new fund, and it's like, I just got taxed to then get the same exposure to the same thing. That seems like a bad deal, you know. And so I do think it offers us some kind of operational efficiencies that are not available to other, you know, basically portfolio wrappers out there. And it's really unique in the marketplace. You know, our ability to operate this fund is contingent on a decade of kind of publishing technology research and really supporting technology companies. And so our support of technology companies in the public markets shows that these management teams, that we are, you know, strong shareholders, that we can give them good guidance and strategic foresight, and then helps us to provide that to the benefit of our clients, and that we can get exposures to these companies that otherwise are off limits to the average investor.
I think that's a great place to leave it. We know that you may have a lot of questions as an investor or an advisor, particularly as we've worked to open up venture capital and private equity as a new asset class, at least for the entirety of an advisor's book. And we stand by ready to help answer questions about the asset class in general, and particularly about the ARK Venture Fund. And as always, you can also go to our website at ark-funds.com for all of the most up-to-date information on this fund and all of those that ARK have to offer. Thanks for watching today. We look forward to speaking with you about the ARK Venture Fund and seeing you on another video here on Funds in Focus.